So we're going to look at the Shiller PE. It was high last year. Guess what? It's even higher now. But we'll take a look at that. We'll look at presidential cycles. The second year tends to be iffy, although we could argue this is the 6th year of a 2-year, but that's a whole different thing. We're going to look at current money flow stats, and I believe we're going to end with what looks like a sleepy market, although today doesn't feel like it, but I'll show you why I think that's the case as well. So let's start off. Okay, Shiller PE. The only other time it's been this high, this is the valuation of the S&P 500. And it's, the only time it's been this high was before the tech bubble crash back in 2000, right? We had a spike, this before the COVID crash, and this was the 1929 crash. So that's not the best, context for where we are in the market, but the market can keep going up. As they say, it can keep going longer than you can stay solvent. So I'm not immediately concerned about this, but it's something you really have to keep in mind and go, at some point, this is going to be a problem. And it could be next week, it could be next year. I don't really know yet, but that's why we watch all the other data that we talk about to give context. But, that's certainly something I'm keeping in mind because I hadn't looked at it in a while. And I'm like, wow, that is overvalued. All right, the second year of a presidential cycle tends to be not the best. Interestingly, January did not fall very much right here, but actually the NASDAQ did actually copy this little bit here. But theoretically or historically, we usually have a good second half of February and into March. So we're not in a bad seasonal time of the year, but the market just seems to be sleepy and not really going anywhere. So that's interesting. And maybe today's changing that, but I actually don't think it is, and I'll show you why. Once we get through into April past tax time, then it gets a little iffy. And then we get the usual, October rallies typically are expected, then maybe a late summer rally. So messy, but, it's to be expected. And maybe we just end up with a flat year, and that's very possible. We've had so many, several good years lately. It wouldn't be surprising to have a flat or very dull year, once we get to the very end of this. So the path we get there is what's going to be fascinating. So watching that closely. Money flow, it's fine, which is, again, interesting because the market's not really going anywhere. It's been, and that's my last slide, so we'll get to that. But, it looks like money flow is fantastic. There's no issues here. When something's wrong, you see money coming out of the market. That's when the market goes down. When there's fear, people start selling and start pulling money. But we're just not seeing it. We're above these two trend lines, well above. Even today, I think we're not, this isn't coming down very much. So nothing to be concerned about there. And even our midterm cycle, we're kind of in this short little upswing. I don't know if it's very strong or very impressive, but that's where we are. But we have been kind of playing in this little mid area, not getting these big dramatic, peaks and valleys. That's where things really are pushing into the market or pulling out. So it's you get a lot more strength when we're up in these areas or down in these areas. Bigger selling strength, bigger buying strength. But right now we're just kind of in the middle. It's not really. It's kind of underwhelming. It's kind of sideways. So we'll look at that too. Major market indexes. I'm not really surprised, but there's definitely a rotation going on. The domestic stuff, the tech, the NASDAQ that has been strong for the last 2 years are just not strong anymore. And we're seeing that in the major market sectors is where we're going to start. Is the top sectors right now are Japan, developed markets, and emerging markets. That is all international. That is not domestic. It used to be domestic. Tech, and that's QQQ, which is actually the worst on this list. It's down here on the right. That's not trending. We get down to mid-cap and Dow are the only really positive spots in the domestic U.S. markets right now. Everything else is just kind of, I keep hearing people saying, oh, it's time for small caps. I don't know if it is. It had a great run and then it gave it all back very quickly. So I always like to say I have trust issues with small cap. They give it back just as fast as it gets made. So I tend to not play in that sandbox very often. If I do, it's for a very quick trade or just to try to grab a little something. But it's a hard game. So I typically avoid it. But yeah, we're seeing international over here, the S&P, China, and tech. That's what's on the weak side right now. So not real inspiring for a positive market. When these all push over to the left, then I'm like, yeah, we've got a strong, broad market across the world. But right now it's just international, not domestic. So that's something to keep in mind. Now, breaking into the S&P sector specifically, energy, industrials, consumer staples, real estate, that's where the strength is. That's not a strong market when you see those leading. And they also XLB, XLE, energy is really not a big part of the S&P either, so that doesn't drive things. But the sectors that drive the market are XLY, which is consumer discretionary, XLK, which is technology, which is right here, discretionary, and financials, XLF. Those are all on the right side and the weakest half. So the market's not going to go up broadly or aggressively until these move to the top of this list on the left side. So that's what I'm getting a sense for, or watching for that to happen. Then we might lean in a little bit more. But we've been skimming, profits off the top as the market has these little peaks over time. There's not a whole lot of reason to get super aggressive. Now today is pulling back a little bit. Maybe that's something we actually buy into a little bit, because we're in a range. We're just stuck in this range that we really can't seem to get out of. And then looking at RRGs, that backs up the sector momentum. XLF looks like it's got potential popping up into the improving. If it pushes into leading, that's a good sign typically. But we've got tech and XLY, that's the just consumer discretionary. That's not doing great. But everything else, all the small stuff looks okay, right? So there's not a lot of reason to be concerned, but it's just messy, right? I like to see these all work together. I like to see them all group up here at the same time. It's even more fantastic when they all group into this red box, and then you see a broad push, all sectors together. Then you get really good S&P rallies, and that doesn't happen very often. But it's something I do watch for daily, because when that setup happens, it's worth catching. It's a wave worth catching for sure. So looking at the new lows, I believe actually today we are back down below this. We're around 115 last I saw, but yeah, just kind of chopping around. Above this green line, and your new lows are less than 50 on the NYSE. There's really not much reason to be concerned. When it comes down below red, it's like, okay, pay attention. And then down below 150, which is down here, is like, okay, we should really see what's going on. But we're just not in that range. Anytime we get these pullbacks, we get the market going. It's like a little bit bad, but nothing worth really dumping everything for. So I think that's still where we are for now, until this really starts to push. Now, if we go back to, if you recall, April of last year with the tariff tantrum, this went to 1,000. So this went, that's a huge number. And that's a valid reason to start playing defense, very aggressively defensive. But we're just not there. We're not in any kind of fear market so far. So here's what I was thinking about. The S&P 500, I don't usually show this, but I think it's interesting. From the tariff tantrum, right? Big, here's the big tantrum area right there, the big sell-off. That's when, new lows were hitting new lows back in here. So it was giving a reason to not participate here. And then it actually was going, drop below to that reasonable rate right in here, right before it gets great. But what's interesting is this slope it was steep, and now it's lessening and lessening. And really since the end of October, actually as of today, we're now flat. So the market has the S&P 500 has gone nowhere since the end of October. Although it's had a couple of interesting little choppinesses. This wasn't very big. These little, this is like 2% up and down. That's not exciting. It's not interesting. And again, the market can't get going until we get the tech and the financials and those kind of sectors participating and being involved. So until we see that, kind of expect more sideways chop. I don't think we're in a bad place yet. If we start seeing those signals, I share the signals, what we're looking at. So if I see those become a problem, we'll definitely be getting more defensive. For now, it's just kind of stay in the course, stay in moderately invested. No reason to be super aggressive here, but no reason to be jumping out the windows yet. So it's all good.